As the U.S. markets are currently closed for the weekend, PPL Corporation, trading under the ticker PPL, closed the last session on Friday, October 10th, 2025 at $27.91. Now, seeing a utility stock like PPL might immediately bring to mind words like stability, dividends, and perhaps boring. The general expectation is that you buy it, collect a steady check, and watch it move with the grace of a glacier. But that perception is now the single greatest risk to understanding what this company actually is in late 2025. The reality is that PPL has undergone one of the most significant strategic transformations in its sector, shedding a massive part of its identity to become something entirely new. The company you think you are analyzing is not the company that exists today, and the market is still struggling to price this new entity correctly, creating a fascinating tension between its sleepy reputation and its much more dynamic and potentially riskier present. Let's first address the common ground, the narrative most people associate with PPL. For years, it was known as a diversified utility with a massive stable footprint in the United Kingdom through its ownership of Western Power Distribution, WPD. This UK asset was a cash cow, a reliable source of earnings that supported a hefty dividend. Many investors, particularly those using platforms like Fidelity or Schwab Intelligent Portfolios for long-term income strategies, held PPL for this very reason. The expectation was simple: predictable, regulated returns from both the US and the UK, providing a geographical hedge and a strong dividend yield. This was the quintessential widows and orphans stock, a safe harbor in a volatile market, a stark contrast to the high beta drama of something like Tesla stock or Nvidia stock. But here is where that comfortable expectation shatters against the wall of reality. In 2021, PPL completed a massive strategic repositioning. It sold its UK business for approximately $10.4 billion and simultaneously acquired the Narragansett Electric Company in Rhode Island from National Grid for about $3.8 billion. This wasn't just a minor asset swap, it was a fundamental reinvention. PPL went from being a transatlantic utility to a purely U.S.-focused entity, concentrating its operations in Pennsylvania, Kentucky, Virginia, and now Rhode Island. This strategic shift forces us to reevaluate everything. The recent trading activity in PPL stock reflects this underlying uncertainty. Over the last few months, the stock has been caught in a tug of war. On one side, you have the powerful macroeconomic headwind of interest rates. Utility stocks are often treated as bond proxies. When yields on safe government bonds rise, the relative appeal of a utility's dividend decreases, putting downward pressure on the stock price. Every time the Federal Reserve hints at keeping rates higher for longer, you can see a direct impact on PPL and the entire utility sector. Volume on these days often picks up not necessarily from panicked selling, but from large institutional funds rebalancing their portfolios. An asset manager at a firm that uses sophisticated tools from interactive brokers might trim their utility holdings to reallocate capital into short-term bonds, offering a competitive, lower-risk yield. This isn't a reflection of PPL's business performance, but a cold, hard calculation of relative value in the capital markets. We've seen PPL stock price dip in the sessions following stronger than expected inflation or jobs reports as the market prices in a more hawkish Fed. On the other side of this tug-of-war is the company's specific story. PPL's management argues that this new, leaner structure is a significant long-term positive. The proceeds from the UK sale were used to dramatically strengthen the balance sheet by paying down debt. A less leveraged company is a less risky company, particularly in a rising rate environment. Furthermore, management is now free to focus all its capital and attention on its U.S. operations. They've laid out a multi-billion-dollar capital expenditure plan aimed at modernizing the grid, improving reliability, and integrating more renewable energy sources. This is the core of the bull case. In the world of regulated utilities, capital investment is the primary driver of earnings growth. When PPL spends $1 billion on upgrading infrastructure, it goes to the state regulatory commissions and says, "We've made these necessary investments to improve service. We now need to earn a fair return on that capital." If the commission approves a rate increase to reflect this new investment, PPL's earnings base grows. The company is projecting solid, single-digit earnings growth for the foreseeable future, driven entirely by this U.S.-centric investment strategy. This is the reality that challenges the old, slow growth expectation. The new PPL has a clearer, more direct path to growth than the old, sprawling version of the company. Anyone doing their self-investing and looking beyond the headline dividend yield will see this planned capital deployment as a key factor. Many are likely managing this kind of investment through a seamless Fidelity mobile app or a SoFi trading platform. So, what does PPL Corporation actually do now? It's an energy and utility holding company. Through its subsidiaries, it delivers electricity and natural gas to over 3.5 million customers in the United States. Its largest subsidiary is PPL Electricity Utilities in Pennsylvania, a stable and well-understood regulated business. Then there's Louisville Gas and Electric and Kentucky Utilities, LG&E, and KU, which serve customers in Kentucky and Virginia. Finally, there's the newest addition, Rhode Island Energy, the former Narragansett Electric. The business model is straightforward: build, maintain, and operate the infrastructure that delivers power and gas, and in return, earn a regulated rate of return on the capital invested. It's a model designed for predictability, not explosive growth like you might hope for from Apple stock. The older reports from before the UK sale are now almost irrelevant for forecasting future performance. The company's debt levels, margin profile, and growth drivers have all been reset. Looking at a 5-year stock chart without understanding this context is incredibly misleading. The drop you might see is not just market movement. It reflects the spin-off of a massive portion of the business. This brings us to the future outlook, where the tension between expectation and reality will ultimately resolve. The bull case scenario for PPL is quite compelling. If inflation continues to cool and the Federal Reserve begins to signal a pivot towards lower interest rates, the biggest headwind for the entire utility sector would turn into a tailwind. This would make PPL's dividend yield, which is still substantial, look much more attractive compared to bonds. Combine that with successful execution of their capital investment plan and favorable outcomes in their rate cases before the various state commissions, and you have a recipe for steady stock appreciation and dividend growth. In this scenario, the market would finally stop viewing PPL through the old lens and reward it with a higher valuation multiple for its improved balance sheet and clear U.S.-focused growth trajectory. An investor using SoFi Invest or Robinhood might see it as a prime candidate for a conservative growth and income portfolio. However, the bear case is just as plausible and must be respected. The primary risk remains macroeconomic. If inflation proves sticky and rates stay elevated or even move higher, utility stocks like PPL could remain under pressure for an extended period. The second major risk is regulatory. While PPL has a good track record with its regulators, public utility commissions are political bodies. They face pressure from consumer advocacy groups and politicians to keep electricity and gas rates low. There is always a risk that a commission could deny or significantly reduce a requested rate increase, which would directly impact PPL's earnings growth. This is a risk that doesn't exist for a company like Nvidia stock, which can price its products based on market demand. A smart investor performing their online investing through an individual brokerage account would need to weigh these regulatory and operational risks against the potential for stable growth. With the current energy landscape, many are reevaluating their portfolios. How much exposure do you have to the utility sector as it navigates the transition to cleaner energy and grid modernization? Comment below what percentage of your portfolio is allocated to utility stocks. In conclusion, the story of PPL Corporation is a perfect example of why surface-level analysis can be so deceiving. The expectation is that you are looking at a staid, legacy utility company with a simple, slow-moving story. The reality is that you are looking at a company in the middle of a major strategic pivot, a U.S. pure-play utility with a strengthened balance sheet and a clear capital investment plan for growth. The conflict between the market's perception of PPL as a simple bond proxy and its new reality as a focused growth vehicle is what defines the stock today. The headwinds from interest rates are real and